Your car has been repossessed. The lender has sold it. Somebody else is driving it. Surely the loan is now finished, or at least close to finished. In a sample of 250 repossessed car loans examined by ASIC, 90% of borrowers still owed more than half of their total loan amount after the vehicle was taken and sold. In some cases, the remaining debt exceeded the total loan amount. Not 90% of every repossession in Australia. Not 90% of every car loan. This was ASIC's targeted sample, drawn from a much larger review of more than 350,000 loans across 8 finance providers. But even with that boundary, the result is hard to forget. The asset disappeared, and most of the debt remained. One of ASIC's severe examples used the changed name Jasmine. She borrowed $34,455. Her car was repossessed and sold after 6 months. The debt remaining was $37,299, more than the original loan, even after the car had gone. ASIC explicitly warns that this and 3 other published cases were selected as the most severe examples, not as the average experience. So how does a car get sold while the borrower can still owe so much? Because repossession is not a return policy. A secured car loan is a debt contract with a vehicle attached as security. If repayments fail, the lender can take and sell the vehicle under the consumer credit rules. The money from that sale is applied against the balance. It does not automatically cancel whatever is left. The debt does not follow the car out of the driveway. Start at the day of purchase. A buyer walks into a dealership thinking about the car, color, kilometers, monthly repayment, whether the children's seats will fit. Finance can be arranged in the same building, sometimes in the same conversation. That convenience can hide how many parties are being paid. ASIC found that loans in its review typically carried 2 establishment fees. The lender's fee ranged from $299 to $995. A distributor fee, which could involve a broker or dealer, ranged from a flat $912 to as much as $2,500. One lender imposed a third fee. In ASIC's highest published example, a $49,162 loan included $9,154 in lender and distributor establishment fees. That was about 18% of the entire loan amount before ordinary interest did its work. The price of convenience can be enormous, especially when the fees are financed rather than paid in cash. Borrowing a fee means paying interest on the fee. The monthly repayment may still look manageable because the cost is stretched across years, but the debt begins higher than the value the borrower may feel they received. Rates varied sharply too. Across the reviewed lenders, ASIC showed interest rates ranging from 10% to 22%. A rate alone does not reveal the complete cost, which is why lenders must provide a comparison rate incorporating the interest rate and relevant fees for a standardized loan scenario. Even then, borrowers need to compare like with like, the same amount, the same term, and the full list of charges. 2 people could leave with similarly priced cars and very different financial burdens. One loan may sit near the lower end of ASIC's rate range with modest fees. Another may sit near the top with several finance charges. Nothing about the second car makes it better. The extra cost comes from the finance pathway. That is why a conversation centered only on the weekly or monthly repayment can hide the most important number: the total amount that will leave the household over the life of the loan. Now add the car itself. Vehicles usually lose value with age, kilometers, and condition. In some regional or remote markets, an older, high-mileage vehicle may be harder to value and harder to resell. ASIC specifically raised concerns about vehicle valuation and said overvaluation can increase the risk to consumers. Then comes default. Interest may continue under the contract. Missed payment or default charges may apply. Repossession, storage, and sale costs can be added to the balance. The lender must sell the car for the best price reasonably obtainable, but that does not promise the retail price the borrower paid. By the time net sale proceeds are deducted, the shortfall can still be large. This is the mechanism: a high starting balance, upfront fees, interest, a depreciating asset, enforcement costs, and a sale price that may be below the remaining debt. Put them together early in a loan, and selling the security may barely reach the principal. And that changes the answer to who really benefits. Where the finance is arranged through a dealership, the dealership receives the vehicle's sale price. The lender and any distributor may receive establishment fees. The lender also has the contractual right to interest, security over the car, and a claim for any lawful balance remaining after sale. The borrower receives the car and its use, but carries the depreciation risk and can remain responsible for the shortfall. That does not mean every dealer, broker, or lender behaves badly. It does not mean every fee is unlawful or every reviewed loan was unsuitable. ASIC's report identified indicators of harm and weaknesses in oversight. It was not a finding that every participating business broke the law. There is another important counterpoint. Default is not automatically a windfall for a lender. Repossession is expensive. Vehicles can sell for less than expected. Remaining debts can be difficult or impossible to collect. A lender generally has reasons to prefer a performing loan. The structural problem is not that every participant wants the car to be taken. It is that some revenue can be collected near the beginning, while much of the long-tail risk lands on the borrower. A dealer or broker who helped arrange the loan may already have been paid before an early default exposes whether the repayment plan was realistic. That is why ASIC focused heavily on distribution. Lenders use third parties such as dealerships and brokers to sell loans, but ASIC's message was that responsibility for consumer outcomes cannot be outsourced. If one distributor repeatedly produces early missed payments, hardship or repossessions, the lender should be able to see the pattern and respond. Location mattered as well. ASIC found that participating lenders approved a lower proportion of hardship variations for consumers in regional and remote areas than elsewhere. That is especially uncomfortable because a car in those areas may not be optional. It can be the only realistic connection to work, school, healthcare, and basic services. All 8 lenders improved their hardship processes during ASIC's intervention, and many strengthened oversight and product review triggers. That is real progress. But it also confirms that the earlier systems had room to improve. For someone shopping for a car, the practical lesson is to arrange or compare finance before falling in love with a particular vehicle. Ask for the comparison rate, the total amount financed, the total repayments across the term, and every lender, broker, dealer, or introducer fee. A low monthly number can result from a longer term or a balloon payment. Neither makes the underlying car cheaper. For someone already struggling, act before the car disappears. MoneySmart says to contact the lender early and ask about a hardship variation. A default notice generally gives at least 30 days to fix the default before enforcement can proceed. The exact position depends on the contract and circumstances, so a free financial counselor or legal service can help with an individual case. If a vehicle is repossessed, the process still has rules. The lender generally has to send a notice within 14 days explaining the estimated value, costs, and consumer rights. It then generally cannot sell the vehicle for 21 days after that notice. During that period, the borrower may be able to pay the overdue amount and costs, repay the balance, or nominate a buyer prepared to pay at least the estimated value. If hardship help is refused or the process appears wrong, a borrower can first complain to the lender and then take an eligible complaint to the Australian Financial Complaints Authority. The National Debt Helpline also provides free financial counselling. Those steps are not magic erasers, but acting early preserves options that can disappear once enforcement is complete. Our view is that the next reform should follow the money back to the point of sale. Every borrower should see one unavoidable dollar figure showing the car price, every financed fee, expected interest, and total repayment before signing. Distributor fees should be reported by lender and by dealer or broker. And when loans collapse very early, regulators should examine whether upfront distributor payments need clawbacks, so the people who arrange the debt share more of the risk. The strangest part of repossession is psychological. We expect giving back the thing to end the bill for the thing. But a secured loan was never just the car. It was the car, the fees, the interest, the costs, and a contract that survives the sale. The car can leave, the debt can stay. So when finance is arranged beside the vehicle, who is checking that the borrower can afford the whole contract rather than just this month's repayment? And if the car is later sold, should the people paid at the beginning carry more of what remains at the end?